Today we will discuss about the liquidity management framework, liquidity adjustment facilities, various variable rates, that is variable rate, repo rate, variable rate, reverse repo, weighted average call rates. What is the RBI intervention to support the systemic liquidity or liquidity at the level of banking sector? What has government to do with it? What is weighted average call rate? And recently committee was internal committee was constituted by RBI on WACR, that is weighted average call rate. So we will discuss all these points one by one so as to clear your understanding on money supply and liquidity adjustment instruments or policies used or deployed by RBI to support the growth or to support the economy. As per this article says that banking liquidity source passed rupees 4 trillion, that is 4 lakh crore, on the 4th of July. So it says that the surplus liquidity has kept the overnight weighted average call rate below the repo rate of 5.50% and overnight tri-party rate, TRAPS rate below the SDF rate of 5.25%. So what is a repo rate, what is the SDF rate? We will discuss all of them one by one, and what is the weighted average call rate, that also we will discuss. But first off, all we should know what is the liquidity adjustment facility. Liquidity adjustment facility is a monetary policy tool used by RBI through which it injects or absorbs the liquidity into or from the banking system. It was introduced as a part of the outcome of the Narasimhan Committee on Banking Sector Reform of 1998. The LAF has two components, that is repo, that is repurchase agreement, and the reverse repo, that is reverse to the repo rate. When banks need liquidity to meet its daily requirement, they borrow from RBI through repo, and the rate at which they borrow fund is called repo rate. On the other hand, when banks are flushed with funds, they park the additional fund with the RBI, and that mechanism is not at reverse repo. So I hope the repo and reverse repo, that definition is clear through this particular explanation. Means repo means when banks need fund, they take it from RBI. Reverse repo is opposite to it, means when they have the excess fund, they park it with the RBI. So it can manage the inflation in the economy by increasing and reducing the money supply. LF is used to aid banks in resolving any short-term cash shortages during the period of economic instability or from any other form of stress caused by forces beyond their control. One thing we should note that the repo rate and reverse repo rate, they may be fixed, they may be variable also, but this fixed rate reverse repo, it was replaced by the standing deposit facility from 8th of April 2022. So when we talk about the liquidity adjustment facility, there is a corridor, liquidity corridor, means the various rates are there in the liquidity adjustment framework. So which rate will be the ceiling rate or the upper bound of that facility, or which rate will be the lower bound or the floor rate? So the marginal standing facility is the upper bound or ceiling, whereas the standing deposit facility is the floor or the lower bound. As on date, your marginal standing facility is 5.75%, your standing deposit facility is 5.25%, your repo rate is 5.50%. So as on date, your corridor is that of 50 bps, that is 5.75% minus 5.25%, then you have 50 bps corridor. Means your rate of interest will hover between these two rates. So we have already discussed what is repo rate. So let's talk about the marginal standing facility. Repo is more of a repurchase agreement that some government securities are there that you need to pledge with the RBI. Against them, RBI will give you loan that will be at the rate of say 5.50%. But at the same time, you need to maintain SLR, say at the rate of 18%. you have the SLR with you, but you have SLR only to the extent of 18%, which is the minimum requirement as per the RBI guidelines. So if a bank want to dip into the SLR security to secure the fund from RBI, means it can do so, but only to the extent of 2% of NDTL. As of now, your SLR is 18%, but out of those 18%, you can use 2% to borrow fund from RBI in a way that you can place those SLR security with RBI. So that will result in reduction of your SLR from 18 to 16%. That's why your marginal standing facility rates are higher than the repo rate, because you are dipping into your SLR bracket. So it's maximum to the extent of 2% of NDTL your MSF can be there, and so that's why its rate of interest is higher than repo rate. Whereas standing deposit facility is simply the facility to park your excess funds with the RBI, and this is the rate of overnight. Standing deposit facilities or overnight, it may be of high tenure, but generally they are of overnight tenure, and that rate of interest is 5.2. Means RBI will give you, as a lender, RBI will give you 5.25% when you park your funds with RBI, and you can avail the fund from RBI say at 5.5 or 5.75%. So why the weighted average call rate? These lines in between, these are the weighted average call rates. So from weighted average call rate, you may come to know whether there is a systemic surplus or deficit. So how we will come to know? Let's discuss about it. When your weighted average call rates, they are above the repo rate, means they are not availing the funds from RBI because they may not have the additional securities. So your weighted average call rate is more of an unsecured nature of financing. So that's why there may be higher than repo rate. Between the banking system, from one bank to other bank, the lending and these activities happen. That is call rate, the rate at which one bank gives loan to another bank. So that is why it's call rate, and they may not have this additional GSEC or SLR securities with them. So they, instead of going to RBI, they take it from other bank at a higher rate, higher than 5.50. So it indicates to RBI that there is a systemic liquidity deficit or the liquidity deficit at the banking level. Whereas when it is below the repo rate, since it's unsecured, and SDF facility is only an overnight facility, whereas this repo, reverse repo, it may be of an higher tenure. So when it's lower than the repo rate, when it's hovering below the repo rate but above the SDF facility, it means then there is a liquidity surplus, because it's just opposite of the deficit situation, that there is a liquidity surplus. And instead of parking it to RBI for say overnight times, it will give only 5.25. Instead of that, they will give the fund to another banker or another bank at a rate which may be lower than repo but higher than the SDF facility. So it will indicate that there is a systemic level surplus. So through this, RBI will come to know that there is a systemic liquidity or systemic deficit. Now, if you go through the monetary policy framework of RBI, it says that the operating framework for monetary policy aims at aligning the operating target, that is weighted average call rate, with the policy repo rate through proactive liquidity management to facilitate transmission of repo rate changes through the entire financial system, which in turn influences aggregate demand, a key determinant of inflation and growth. Means not only affects your liquidity, but it can also affect your aggregate demand. So hope now, till now, my explanation has been of use to know about the liquidity or liquidity adjustment facility. So how RBI detects the liquidity surplus? We have already discussed that when the call money market, if the rates are below the repo rate, it suggests that the banks have excess liquidity and are lending at cheaper rate to each other instead of taking the funds from RBI, they are giving to each other at a lower rate than RBI. So the RBI comes to know that there is a systemic liquidity surplus. So RBI uses tools like variable rate reverse repo to absorb extra funds. Large bids by banks shows the surplus. So RBI gauges the liquidity condition through liquidity adjustment facility operations, that is money market operation. This is money market operations. The press release dated August 8, 2025. What does it say? That so these are the liquidity adjustment facility by the RBI. These are the market operations, money market, and these are the RBI operations. Now what RBI operation says? RBI operation says that in the fixed rate there is no transaction is there in the fixed rate. Variable rate, there is a variable rate reverse repo. Means there were systemic surplus was there. That's why through reverse repo the excess liquidity has been absorbed. Then the marginal standing facility means some funds were infused in the system. Then SDF was also there. So overall, a net liquidity which was absorbed from the system through say reverse repo or through SDF, net of this MSF, it was minus 1,24,000 crore for the particular day. And if you talk about the outstanding position, so outstanding position is minus 3,54,931 crore. So that fund is absorbed as on date by the RBI through the liquidity adjustment facility. And how the absorption will work? Absorption will work from this VRRR, variable rate reverse repo, plus you have SDF facility, minus you have say marginal standing facility, because marginal standing the funds are infused, and minus you have variable rate repo. These facilities may be there. So if this is positive, it means there is an absorption by the RBI, and the other way around. When banks park money with the RBI at the reverse repo rate, indicates they have excess liquidity. A larger amount means there is a high surplus. And banking system data, daily flow from government spending, forex intervention, IPO refunds, tax payment, GST related, some due dates are there. So through that RBI tracks that there may be some system liquidity, or that deficit may come into picture considering those events. So as per the article, it says that net banking system liquidity stood at 4.09 trillion. It means bank collectively park 4.09 lakh crore RBI via this variable rate reverse repo operation on that day. This parking fund signals that banks have excess cash that they cannot need for lending or other use. So one more question that may come into your mind, that how the government spending increases the liquidity. You know that there is the RBI, then there are banking system, there are banks, and government is also RBI, because government funds are also with RBI. So funds which are there with the banks, that is banking liquidity. When the RBI takes that fund, the banking liquidity will come down. Whereas when RBI injects the funds in the banks, the banking liquidity will go up. This is the common explanation. So the government spending injects liquidity into the banking system because it moves from the RBI's account to the public account held with the commercial bank. So government holds case with RBI because RBI is the lender to the government also, or it manages. It's like public debt office of government is with RBI only. So the central government keeps it or maintain its main account with the RBI, known as Consolidated Fund of India. This account is outside the bank system, and money parked is not counted in the market liquidity. But when this money parked is infused back in the system, it results in higher liquidity with the banking system. When the government spends, say on the salaries, project, subsidy, or like disburse funds, the funds move from the RBI account to bank account to the individual companies or vendor accounts. So it results into surplus in the banking liquidity. This inflow becomes a bank deposit. So this money credited to people's or company's bank account increases the deposit, the bank sum. This adds to the total liquidity available with the bank. More deposit means more liquidity. With more deposits, banks have more fund available to lend, to borrow, invest in security, park in RBI reverse repo window, if lending demand is weak. So our bank can do what, as per their requirement. With the more deposit, either they can invest in GSEC or investment in SLR security, non-SLR security, they may lend it. Or when the investment or loans demand that is lower on lower side, what they can do is they can park it through a reverse repo mechanism or SDF facility, or through variable rate reverse repo. They can use that mechanisms to park their money. What are various measures of money supply? Let us discuss this also. Through it, we'll come to know what is short-term liquidity, what is the durable liquidity concept. So money, simply M1 means there are M1, M2, M3, M4. These four things we'll discuss as of now. The M1 is currency, that is notes plus coins held with the public, and net demand deposits held by the commercial. Demand deposit means whenever it is demanded, the bank will have to own it. Means it's as good as cash. So this is M1. So net implies only deposits of public held by banks are to be included. Means bank to bank deposits, that is to be excluded. M2 means M1 plus saving account deposit held with post office. M3 means M1 plus time deposit, they are also taken. M4 means M3 plus again time deposit with post office. So here narrow money is M1 and M2, and broad money is M3 and M4. M1 is the most liquid, as I told, that's like currency with the in hand or net demand deposit, whereas M4 is the least liquid of all. So what are the instruments available with RBI to manage the liquidity? So when we say the liquidity, say it may be a short term or transient liquidity. So to infuse the fund, what RBI will do is RBI will variable rate repo will be there, or marginal standing facility will be there. This is to infuse the fund. And to absorb the fund, short term, I'm talking about the short term, RBI will use variable rate reverse repo or SDF facility, and foreign exchange swap will also be there. Similarly, for durable liquidity, there will be long term repo and long term reverse repo, and then open market operations. OMO means what RBI will do is through OMO, say RBI will issue government securities of a particular tenure, some dated security, say maturity of 5 years. So it will issue and it will absorb the fund. Then it is done in the secondary market. Now, okay, you are getting it. In the open market operations, not a primary issuance. The secondary market through secondary operations, it's more of a secondary operation. RBI will buy some government security or sell those security in the secondary market to adjust the liquidity. So this is more of a durable, because it's not a overnight or say some 13 or 14 days task. It is the secondary operation. RBI can hold it and again it can sell it in the secondary market, considering the market liquidity situation. So here the variable rate or variable repo rate, it may be say 1 to 13 days variable rate repo, reverse repo, or 14 days variable rate repo or reverse repo, they are conducted. Whereas in long term repo, reverse repo, they are generally more than 14 days. So that is the difference. So this 14 days, more than 14 days makes it a durable liquidity. Whereas up to 14 days, it's like transient or short term liquidity. So what's the relationship between the bank credit and liquidity? So when bank rate demand is low, surplus liquidity tends to build up. This is because banks are not deploying funds as loans, so money stays parked in the system. Despite the RBI effort, liquidity is high, implying that credit absorption is very low and stable. Especially considering the volatility in the market, especially in the current scenarios of the projects, they are not getting started. People, as of now, they are only observing, and the credit demand is not much higher because they don't see any visibility in near future, or some volatility consists in the economy or even at the global level. So that's why projects are not getting kicked in. So RBI tries to absorb excess liquidity through tools like VRRR or say SDF to prevent the interest rates falling too much below the policy rates. So this is how we have studied variable rates, weighted average call rates, liquidity adjustment facilities, money market operations, surplus, deficit, money supply till now. So now this is the weighted average call rate as the operating target of the monetary policy. We have seen that it may also affect your aggregate demand. So it is not only relevant for your inflation targeting or your interest targeting, but may also be relevant for your at the economic level from the financial stability level. So an internal working group of RBI recommended to retain the overnight weighted average call rate as the operating target for the monetary policy, citing its effectiveness by policy transmission. We have seen that monetary policy operations of RBI, you see the call money, the volume are 20,000 and the rate, if you see, it's 5.44%. So it's just below 5.50. Means still there is liquidity, a little bit of liquidity, because as per the article, if you see the article, at that time your this weighted average call rate was is given like 5.37. The weighted average call rate was 5.37. So now it has inched up to 5.44, means liquidity has been absorbed, surplus has been absorbed to a great level. That why it improved, the weighted average call rate improved from 5.37 to 5.44% within a span of say 4 to 5 days. So here your call rate is weighted average call rate is 5.44, where it comes to the tri-party segment it's 5.39, and a market repo is 5.26 and 5. So these two are very relevant. We are going to discuss them, that what is weighted average call rate. Tri-party repo is, and the tri-party repo is something which is not by the RBI as such. It is the tri-party is there, that is Clearing Corporation of India, that is like that assumes the settlement risk, and one borrower is there, one lender is there. They don't know each other, they only deal with the Clearing Corporation of India, and the difference is with call rate is unsecured, whereas this is collateralized. TRAPS is collateralized, means the collateral is government security. That's why you see the rates are a bit higher in the case of tri-party repo. So coming back to the article, it says that also suggested to discontinue the 14 days VRR or reverse repo VRR auction as the main liquidity operations. It also suggested that to do so. Instead, it called for managing a short-term liquidity, say up to 7 days, or other shorter tenure, or up to 14 days as per RBI's discretion. The group was set up for the existing review of the liquidity management framework, which is in place since Feb 2020. The report added that WSCR directly influences short-term interest rates and effectively conveys the central bank's stance on liquidity and monetary conditions. Unlike collateralized rate, it more accurately reflects credit and counterparty risk. Since central banks are the sole supplier of reserves, they have greater control over this rate. Because as I told you, in collateralized rate or say TRAPS rates, there is no counterparty risk, there is no credit risk, because there is collateral is already there, and counterparty risk is assumed by the counterparty, that is CCIL. So we may not know what actually has been happening in the interest rate scenarios, because they are getting affected by these risks which are obviated in this case, in the case of TRAPS rate. So we may not come to know what actually the picture is. So a stable and a predictable uncollateralized rate also supports a smoother monetary policy transmission by anchoring rate across maturity. It further said that while the collateralized segments such as TRAPS or market repo comprises a large share of overnight market volume, they are heavily influenced by non-bank participants like mutual funds, insurance companies, pension funds, which are outside the RBI's regulatory scope. If you see this money market operation slide, you see the volume is only 20,000 in this case, whereas in the case of tri-party repo it's like 3,75,000. In market reports like 1,97,000. So volume are there in the tri-party or market report. Both are collateralized lending, whereas call money is uncollateralized. So that effect is influencing those rates in the determination. And of course, the mutual fund insurance companies, they are also using these traps or your market repos. So it may not actually depict the true picture, which is the case with weighted average call rates, because it's uncollateralized. So despite the WCR and call rates show a high degree of correlation alignment over time, the report highlighted. Share of the call money market in the total over market volume has declined over the years, raising question about its effectiveness as the operational target of multiple. So this was the case because you see the volume that has drastically come down. So that's why the internal group was constituted, and to find out whether it should remain the operating target or it should be changed. Between financial year 14-15 to 24-25, in these 10 years, the annual turnover in the overnight money market rose significantly from 281.37 trillion to 1324.05 trillion, and the daily average turnover increased from 1.17 to 5.52 trillion. The sharp growth was driven almost entirely by the expansion of collateralized segment, whose turnover jumped from 245.27 trillion to 1296.62 trillion. In contrast, the turnover of uncollateralized call money market declined from 36.1 trillion to 27.42 trillion in the same period. A segment of the market was expecting the central bank to change the operating target to collateralized base traps rates. There were expectation of shifting the operating target to the traps rate, as it is more secured in collateral base. It also has the highest volume in the overnight money market. But as we discussed, that it is influenced by the credit risk, it is influenced by the counterparty risk, it is influenced by the participants which are not regulated by RBI. So because of that, weighted average call money has been retained as the operating target. To reduce market uncertainty, the group suggests that the RBI provide at least 1 day's prior notice for such operation, while retaining the flexibility to conduct same-day operation also. Additionally, the group advocated continuing the use of variable rate auctions, given their superior price discovery and efficient allocation of reserve. Though in fixed rate, their fixed repo is like 6.50% only. But when we do the variable rate, there are auctions are there, reverse auctions are there. So there is a better price discovery. Because of that, it should be retained the way it is as of now. So for situation involving more persistent liquidity mismatches, it recommended deploying longer tenure variable rate operation. This is to ensure liquidity assurance and reduce reliance on frequent short-term intervention. The report also said that banks are generally hesitant to deploy funds in the 14 days reverse repo auction. Instead, they prefer put it in the daily standing facility, that is overnight. I already told you, and as of now it is 5.25%, and 14 days reverse repo auctions, that will depend on the price discovery, what will be the rate of for that. The reason for this 14 days hesitation is given here. While participation in the fine-tuning VRR auction has been higher, the frequent use of these operations contribute to market uncertainty around RBI liquidity management approach. This reluctance largely stems from banks' limited visibility on various frictional factors, such as fluctuation in the central government's cash balances. So as we discussed in an earlier para, that how the government's spending can increase the systemic liquidity. So that is a frictional factor, and banks, they are not sure of that whether government is going to do something. So because of that, they are reluctant in using the 14-day or say 0 to 13 days or say higher tenure VRR. Instead of that, they use the overnight facility and deploy the fund in SDF. Hence, the effect in 14 days is addressing transient liquidity that is very limited. For higher liquidity, you have long-term repo that is variable only. Repo, reverse repo, and open market operations are there. Further reports suggest that the existing set of instructions under the liquidity management framework, including the open market operations, long-term VRR operations, and foreign exchange swap actions, are adequate for managing the durable liquidity and therefore do not require any change at this stage. So here, this reluctance has been explained very nicely, that why this 14 days horizon timeline for the VRR or VRR should be discontinued or not be discontinued, but may be used on selective basis at the discretion of RBI, because of this fractional factors are there. So final recommendations are to discontinue it or use it at the discretion, or some shorter term, say up to 0 to 7 days, some shorter term VRR or VRR can be used. Second is managing short-term liquidity through 7 days, this shorter tenure, the RBI discussions up to 14 days says at least 1 day prior notice should be given. Sorry. To reduce the uncertainty, the same day reports can be used when needed, means again at the discretion. Then OMO, long-term VRR and FX are adequate to manage the durable liquidity. Hope this video helped in gaining the concepts, knowing the current economic scenario, especially with reference to RBI's liquidity management, various concepts, various definitions, and how things move, and especially with reference to this committee suggestions on weighted average call rates. Thank you for watching.